My task is to drill down a little bit, just for a very few minutes, into some aspects of the European situation. On the brink seems like a safe title. On the brink of what? Or who is on the brink? Now, in addition to providing us with a highly plausible global macroeconomic forecast, Mike Muss's paper contains, I think, one of the most elegant and forceful, well, perhaps not elegant, but forceful statements of principle with regard to banking policy that I have seen recently, and I follow these matters carefully. For those of you at the back, I'll read it to you. He says, it's on page 7 of the distributed version, "The time has long since passed for public officials and central banks to stop kissing and start kicking the posteriors of bankers whose self-interest diverges substantially from the public interest." What he means, and he says this quite clearly in his paper, is there's a need to raise capital ratios of European banks to reflect the risks of the falling market value of sovereign debt holdings, primarily in Europe. They need, if I paraphrase it slightly, they need more loss-absorbing shareholder equity relative to their assets. And the right approach, Mike, obviously this wasn't his focus of his paper, and he can speak for himself shortly, but I think he would agree that the right approach is to use tough stress tests to determine who has what kind of potential losses. And this is obviously something that hasn't yet happened in Europe. After 2 rounds of tests, we really don't know who could face what kind of losses, and there isn't confidence in the market that enough capital is in place. Now, similar ideas have been articulated, as I'm sure you're aware, by Christine Lagarde, the managing director of the IMF, and this is one long quote from her Jackson Hole prepared remarks. Let me just highlight the middle part of the quote. The most efficient, she's very much on the same page, I think, with regard to what needs to be done broadly. She thinks that the most efficient solution would be mandatory substantial recapitalization, seeking private resources first, but using public funds if necessary. And she proposes, and actually Mike has some numbers in his paper around this kind of proposal, and I think that's probably similar to what we'll see coming out from IMF documents in the next couple of weeks. But she says we could, or the Europeans could mobilize the European Financial Stability Fund or other European-wide funding to recapitalize banks directly and therefore avoid placing even greater burdens on vulnerable sovereigns. Now, the reaction of the European banking community has been categorical. In fact, the policy community in Europe. And I'm going to call this, because I need a shorthand, Ackermans Rule, which of course you could interpret the rule in a number of ways here. Mr. Ackerman, Joseph Ackerman, the head of Deutsche Bank, said last week that, first of all, what's been demanded from well-known figures that banks face mandatory recapitalizations, I think nothing at all of that. That was one quote. At I think the same event, but quoted in a different news story, he said, and I think this is the most important part of Ackermans' rule, it is stating the obvious that many European banks would not survive having to revalue sovereign debt held on the banking book at market levels. And I think that's actually true. And I think that is the heart of the financial problem, the downside risk, I would suggest, to Mike's forecast, and one that he talks about himself, and a big part of the political economy issue now unfolding in Europe, particularly in Frankfurt. Now, just to pause for a moment and to put some numbers on Ackermans' rule. These slides are not in your package, but we're happy to share them with you. Afterwards. And I did put footnotes in there for those of you who'd like to go away and look at the stuff for yourself. All the Deutsche Bank data come from their website. This is their second quarter financial results. Deutsche Bank, so Mr. Ackerman said in the context of these other remarks I just quoted, he said Deutsche Bank is more strongly capitalized than ever before, and he said it's having absolutely no problems with refinancing, all of which I have no reason to dispute. And I would stress I'm only picking Deutsche Bank as an example, and perhaps an example of a relatively well-run and perhaps a relatively well-capitalized bank in the European context. And that we don't know because the stress tests have not revealed it. Deutsche Bank at the end of the second quarter had assets of around 1.85 trillion euros. It had total equity of about slightly over 51 billion euros. So the assets has a trillion. and the equity is billion, and the difference between those, or the ratio of assets to equity, of course, the simplest measure of leverage is about 36. Deutsche Bank, to be clear, prefers a different measure of leverage, a lower measure, but this one they also confirm and report on the relevant part of their website. Now, the capital ratio of Deutsche Bank, and remember, let me remind you that what Mr. Ackerman spoke to very specifically is capitalization. Capitalization is a regulatory concept, among other things, and Deutsche Bank, like all banks, has a ratio which they are required to attain, and a ratio that they want to communicate to the market. This does not use total assets. This uses what's known as risk-weighted assets, and the risk-weighted assets of Deutsche Bank at the end of the second quarter were 320 billion euros. Now, when you calculate the capital ratios, equity relative to risk-weighted assets, you get numbers that are high, considered high in today's banking world. Deutsche had a Tier 1 capital of 14%. That was up nearly 2% from the end of 2010. And it had a core Tier 1 capital in which you remove hybrid instruments that are not generally considered to be as loss-absorbing as shareholder equity. It had a core Tier 1 capital ratio of 10.2%. Now, that counts as a well-capitalized bank. But the key issue here is the risk weighting. How do you get from 1.8, 1.9 trillion euros, the total value of assets on Deutsche Bank's balance sheet, how do you get to a risk-weighted asset position of 320 billion euros? Well, I don't know the full degree of detail. That's not revealed, has not been revealed by the stress tests in enough detail to give us confidence. But one's presumption should be that they are holding a substantial amount of, they and other banks, this is not, again, nothing special about Deutsche Bank, they are holding a large number of assets that have a zero or near zero risk weight. Now, what would be those assets? They may well be holding some subprime mortgages, securitized, which, as you know, Standard & Poor's continues in some instances to give a AAA rating to, quite a striking contrast with their rating of US government debt. But for the most part, I think we can presume that these European banks are holding large amounts of European sovereign debt. Now, this is not to say that Deutsche Bank is holding Greek debt. Deutsche Bank may not even be holding Spanish or Italian debt, but other banks in the European context are holding that debt, and other banks in the European context are also not marking to market. They're not following the Musa principle or the Lagarde proposal, and they have no intention of doing so. And there are no stress tests in the works or plans that would reveal the full extent of the potential issue here. If you scale Ackermans, so Ackermans Rule basically is that one could absorb a small amount of losses, for example, in a Greek restructuring deal, but it has to be contained and limited and ring-fenced to Greece. If it spreads, if there are actual losses, actual restructurings, of course, this is where Carmen's historical evidence is highly relevant and deeply worrying, either actual restructurings or just a reduction in the market value, and Mike explains to you in his paper why you should care about the reduction in market value, even if there aren't actual defaults, and why one should expect contractionary effects if the banks don't have enough capital, even without defaults. If they don't have enough capital, this is what's going to play a big role in exacerbating the slowdown. Now, there are different ways to scale this. There's no perfect way to think about debt to GDP. It depends on whose GDP we're talking about and how much debt we think is being pushed towards relatively solvent countries. It also depends, as Mike says in his paper, on the view that you take of the primary surplus in Italy. Mike is a little bit more optimistic about that, looking forward, than I think I would be on the basis of the latest data, but we don't know where this goes. The point, though, I would emphasize is very much consistent with what Carmen just told you, which is there are many ways to hang yourself in terms of losing your fiscal sustainability. One way that Carmen talked about, that actually everyone in this room should be fully aware of, is the morphing of private sector debt into public sector debt, which is what's happened in the United States. But another way to do it is to run large deficits. That's part of what happened in some places in Europe. Or to run a high level of public debt during a boom, relying predominantly on bank financing, resting on what we used to call Basel II principles. Now, of course, this is still in Basel III, largely unchanged, which is putting a very low risk weight on sovereign debt. Sovereign debt, Carmen's history tells you that if there is just one thing you should know about sovereign debt, only one thing, it's not risk-free. And that's not a statement limited to Greece. Now, I don't have time to go through with you the full sort of alternative ways of analyzing this, and the countries just in the display of this slide, the countries' names you can't read, and that's just to make you go look at the paper for yourself. This is a very nice paper produced by Jonathan Ostry, Atish Ghosh, Jun Kim, and Marvash Qureshi, an IMF staff position note from September of last year called Fiscal Space on the IMF's website. And they go through one form of analysis you can do of thinking about who has the ability to increase their debt to GDP without running into sustainability issues. And it's based on the historical experience of these countries. And the thing I would flag for you, this is a paper you should look at or print out in color. It doesn't work in black and white. And the reason is that they have a suitably technical and delicate way of presenting this, because they're very good IMF officials. But the countries that are colored in red, if you'd read this paper September last year and bet against the countries that were colored red here, you'd have done very well. These are the countries that are running out of fiscal space. These are the countries that were in danger in their analysis of going too far in terms of debt to GDP and not being able to bring it down and bring it under control. Countries that can't do sufficient fiscal adjustment. And I would suggest that anybody who's seriously interested in this issue, anybody who wants to think about the plausible alternatives in Europe, start with this paper by Ostry et al. In conclusion, I think I would say there are three kinds of financial fiscal disasters, if I can offer a classification that fits, I think, with Carmen's broader view. The first you know all about. You've seen the HBO special. You've heard about it ad nauseum in the American context. It's called Too Big to Fail. My favorite quote actually comes from Canada, because so many Americans are convinced that the Canadian bank system is wonderful. Ed Clark, who is CEO of Toronto Dominion Bank, you see it all around town here as TD Bank, said in January 2009, quote, maybe not explicitly, but what are the chances that TD Bank will not be bailed out if it did something stupid? That's banking philosophy 101. And of course, the license plate that's worth 1,000 words on this is that of Robert Kindler, the vice chairman of Morgan Stanley after the crisis. If you can't see it at the back, it's a Cayenne Turbo, a type of Porsche with Greenwich plates, and it says "too big to fail." So that's number one. Number two, of course, is the Irish. So that's too big to fail. Number two is the Irish variant, which is too big to save. 3 big banks, 2 times GDP, they blow themselves up. The efforts to save them, the Irish banks ruin the Irish fiscal accounts and plunge them into an unsustainable situation from which one can only hope they will be rescued by the joint efforts of the IMF and the European Union. So we have too big to fail and too big to save. We also have what's known in the philanthropic world as a naming opportunity, which is the current European situation. And I don't know, they're too something to something, but this is you can make a name for yourself by coining the term. I can only turn to the remarkable, if not stunning, events of the past 24 hours, where we had Jean-Claude Trichet give this impassioned defense of the impeccable, a word he uses repeatedly, impeccable record of the European Central Bank with regard to price stability. If you haven't seen the video clip of this, you must go look at it this afternoon. In fact, Jacob Kierkegaard, if he's here, can send it to you with a great commentary that he has. But you must look at this. It's really remarkable television, among other things. And of course, this morning, Jürgen Stark, the governing executive committee member, a German national at the European Central Bank, announced that he's resigning effective the end of the year. And just to quote the Wall Street Journal news alert I got on this topic, not that anybody's had a chance to write a full story yet, the person familiar with the matter said Mr. Stark is leaving due to a conflict over the bank's bond purchase program. This is where the Ackermans rule goes. If you can't have big, serious fiscal restructuring, because that will, among other things, bring down all the banks and therefore exacerbate the fiscal problems massively, everyone's looking at the central bank, the European Central Bank, to buy the bonds, presumably, of countries that are in trouble, including, we know they've done this already for Spain and for Italy. This leads to the naming opportunity. It leads to a huge fight, one presumes, at the European Central Bank. And I think it poses both downside risks to the growth projection and presumably downside or inflationary risks to the price forecast that Mike laid out as well. Thank you.